Okay, so I'm going to talk about estate planning, succession planning, and what we've got going on. Some of this it may be really elemental for some of you, but I want to back up and just so we all know where we're coming from, where we may be going, and what we can do. And I'm going to just jump in here because I know I've got short time and there's lots going on today, so we'll just jump in. Oh. Okay, so where are we now? So just to this, and this is the elemental part that I may be explaining to you that already know this, but I'm going to go through it anyway. So the current estate tax exemption is $11.7 million per person. That's husband, wife. So combined, we're over $23 million right now. And that is indexing for inflation, so it's going to go up next year if no other change happens. And they're estimating it to be around $12.4 million per person. So for a lot of us, that's not a problem, but with the land prices increasing, it is a problem for some farmers, certainly. The estate tax rate, once you get above the exemption, is 40%. So if you are at $12 million, they're going to take that $300,000, and they're going to tax it at 40%. And then that is actually, we always refer to it as an estate tax, but it's actually a combined gift and estate tax. So you can give during your lifetime. Let's say you give $1 million gift during your lifetime. And what you do is you file a gift tax return when you make that gift, not because you're going to pay gift tax on it, but because the IRS is keeping track of what's happening. And so you file a gift tax return, say, I made a gift of $1 million, and that reduces your lifetime exemption by $1 million. So now you've got $10.7 million left to make other gifts during your lifetime, or to give that amount at your death. So that's kind of how that works together. Now, even under the Trump bill, which basically doubled the exemption, it was set to sunset at the end of 2025. So January 1 of 2026, it goes back to what that exemption was previously. And that was $5 million increasing by inflation, and we're estimating that if everything remains the same, that'll drop back to about $6.4 million per person of exemption. The other thing I want to point out is, in 2011, it used to be, and there's a whole bunch of people out and around that have two trusts, or they've got things divided up so they can take advantage of both spouses' exemptions. In 2011, there was a new provision put into the federal estate tax laws called portability. And basically, if you file an estate tax return at the death of the first spouse, you get to save that spouse's exemption, regardless of whether you had the assets put in two trusts and two different buckets. So the reason I point that out is because, with the estate tax exemption being large for a long period of time here, I think sometimes we kind of neglected to advise people to file a federal estate tax return when the first spouse passes away. So this is really important right now because we don't know what's going to happen with the exemption. We don't know what's going to happen with the whole landscape. So I think if there's any risk that you may be over the exemption, it's a cheap insurance policy. Talk to your advisor, talk to your accountant about filing a federal estate tax return if a loved one has passed this year. You've got 9 months from date of death to do it, or to file an extension. So if that's your situation, you need to make sure that you've at least talked about that so that you can capture the exemption of that person that passed away. So I've got several clients. I mean, it's really important right now. I've got clients that are passing from COVID. I mean, it's just clients are passing. So I'm making sure to talk to them about, do you need to file a federal estate tax return? You probably don't have a problem with your $11.7 million exemption, but let's capture that. And I don't know, they might try to roll some of that back, but at least we've got it to work with if we need it. It was probably not going to be a problem if that level remains the same, but if they roll it back to $3.5 million, you may have a problem, especially with the way land prices are increasing. So it's something to be thinking about. And then the annual exclusion gifts, I think most of you are familiar with these. These are gifts that you can make to anybody, to your kids, to your grandkids, to their spouses, and you don't have to report it to the IRS. I think a lot of my clients are under the misconception that this is all you can get, which is not the case. It's just that once you get over that $15,000 per person that you give it to, you actually have to report it to the IRS. Now, people do it all the time where they don't report it, but this is technically the rule. coming up on basis, again, hopefully this is not new information to you, you already know this. But your basis in the property is the value at the time you purchased the property, or the time you inherited the property, or the time the property, if it's not the time the property was gifted to you. I'm going to kind of go through an example here. So, and you all know what appreciation is. Especially on land, this is a big deal. It's a rise in value over time. So we talked about stepped-up basis. Stepped-up basis is when you pass property at death, the effective transfer time is death, then you get a stepped-up basis. Meaning, I'm going to go through an example here in just a second, but you get that new stepped-up basis, and that's what we want. Stepped-up basis is good, okay? Everybody understand that stepped-up basis is good. Transferred basis is when you get somebody else's basis in the property if they gave you a gift during their lifetime. So even if your mom and dad have the property, but they gave it to you or they sold it to you at a favorable rate during their lifetime, if they gave it to you, you still get their basis. If they sold it to you at a favorable rate, that favorable rate that you purchased it for is actually your basis in the property. And this all matters because this basis is how we determine how much capital gains you have on the property. Okay, so here's an example. If you buy a farm in 1980 for $100,000 and the farm is now worth $500,000, if you sell that, most people are aware of this, but if you sell that farm during your lifetime, you're going to pay capital gains tax on the difference between what you bought it for and what you sell it for. So that $400,000 difference, you're going to pay capital gains tax rate, capital gains tax on, which is technically an income tax. And then if you gift the farm, if somebody gets the farm to their children during their lifetime, that's the transfer basis, right? So maybe they bought it when it, many years ago at $100,000, it's now worth $500,000, but they give it to you during their lifetime. And maybe they're doing that for, to keep it out of the hands of the nursing home. There could be a million different reasons that they do that, but if they transfer it during their lifetime, that basis transfers with it. So it's important when you're talking to your advisors, your accountants, that you know, how did I get it? Did I get it at death? Did it pass by beneficiary deed? Did it pass by will? Did it pass by trust? Those are all effective at death. But if you actually got it, even shortly before your parents passed away, that's a transfer basis, and you actually get your parents' basis in the property. If you get it at death, that's what I was hinting at, however it was, the effective transfer was at death, then you get that stepped-up basis. So that's what we're really trying to get to, especially with the way, it's all assets are really like this, but land is the one we're primarily concerned about because it's appreciated so rapidly over the last 30 years. Okay, and this is where I may dovetail kind of with what Veronica was talking about. But the American Families Plan is the proposal from the Biden administration. And interestingly enough, there's nothing in this right now about changing the federal estate tax, the exemption of $11.7 million. That Biden did propose when he was campaigning to drop it to $3.5 million, but it's not in this most current plan. So I think that they've decided that maybe it's not worth the political capital to get this through. This is maybe what Veronica could answer better than I. And have kind of fallen back on that, especially since it's going to sunset in a few years anyway. So we're dropping back in 2025 anyway. It may not be worth the political capital to spend to get that pulled back. So, but it does have a lot about capital gains, which is that you pay capital gains at the time of your death. So in my previous example where you're going to build in capital gains of $400,000, typically that would have just gone away if you held that land when you passed away. But they're proposing that that be a taxable event, that be taxable for capital gains tax purposes on that $400,000. And if you get it during your lifetime, that's also a taxable event. So going ahead and trying to get it to your kids during your lifetime, if there's a built-in capital gains of $400,000, they're going to tax that. And as Veronica mentioned, an exemption for $1 million of capital gains, which, depending on how much appreciation you've got built in, it's not very much. It doesn't go very far for a lot of farms. She did mention also the exception for family-owned businesses, and that is, it's a little uncertain exactly what that's going to look like, but it does probably look like you have to continue to farm. So for people with highly appreciated assets where the next generation is not going to farm, or all the next generation is not going to farm, even if they may be selling it between siblings, that's where it's a little bit unknown what that's going to look like. And as I mentioned, there's no proposed changes to the estate gift tax. Okay, so that's the major one. There's a couple others floating out here that are getting news, and all this kind of gets mushed together in the press. But for the 99.5% Act is proposed by Senator Sanders, and it decreases the estate tax exemption to $3.5 million, and a lifetime gift to $1 million, and then increasing the rate once you get over that $3.5 million to it escalates, but it's between 45 to 65%. And somebody who was advising Bernie Sanders was either an estate planning attorney or knows a lot about estate planning, because there's a lot in that bill that targets very specifically the tricks, I don't want to call them tricks, but the tools that we use to try to bring down the value of estates through different types of trusts, different types of gifts. That bill really heavily targets those possibilities, and hopefully some of the things that are already in place will be grandfathered in, but we don't know that. So it's pretty, this one actually probably frightens me the most of all the bills that are proposed. And so it also limits the annual exclusion gifts, which that's $15,000 per person per year, to only $30,000. So you could give it to two different people, but once you get to that point, you're going to get taxed on any gifts over that amount. Okay. The STEP Act, which stands for Sensible Taxation and Equity Promotion Act, I'm not going to comment on the name of it, but as Veronica mentioned, was sponsored by Senator Ed Holland. That one is focused more on the transfer tax. So you're going to pay capital gains tax at the time of death on lifetime gifts. And then there's also, there's no reason you should necessarily know this unless you're in one of these, but there's a lot of trusts that are already in place they're called Dynasty Trust or GST, which stands for Generation Skipping Transfer Trust. And the nice thing about those trusts is when you put them in place, you kind of solved your estate tax problem at the time you created those. And it just goes on perpetually, and you don't have to solve that with each generation. Well, they know that. And so they're trying to basically say that there would be a periodic gain or periodic tax on the capital gains in those trusts. And the proposal is every 21 years that whatever capital gains are in those trusts, that they would get taxed. Okay. Now this is what keeps me up at night. But pretty severely. I mean, it's really hard to advise producers, farmers, ranchers right now because we don't exactly know what it's going to look like. But the scary part about it is that they are talking about retroactivity. So the Biden's proposal, most of that takes effect at the beginning of 2022. But there are certain proposals that would go all the way back to January 1. There's some that go back to the date of proposal, and there's some that that would go to the date that it actually passes and is enacted. So, I've got lots of people that are kind of in the wings thinking about what am I going to do? Should I pull the trigger on this? And the scary part is that if some of these pass, maybe we're already too late. But I think there's some questionable, whether that's constitutional or not, I think is certainly questionable. But that means we may have to fight it out in the courts if that's what they ultimately do. And we'd rather not do that. But it's a little bit worrying. And as I said, this is what kind of keeps me awake at night. So, okay. So what do we do? This is where I want to kind of focus our attention today. There's no one size fits all. I know you'd like for me to come in here and say, this is exactly the plan that you should follow, and this is going to work, and everything's going to be fine. But there's so many unknowns, and there's so many different proposals that you might zig when you should have zagged. And so it's a little bit, you've got to look at your specific situation. And obviously, even if this makes sense for a lot of people, it may not make sense for you because of the family situation, because of a million things. So it is specific to your situation. But one of the things I'm talking to some of my clients about is the opportunity for a large gift this year. Now, whether they will do that or not, I don't know. I've got a lot that are kind of in the wings and are prepared for that, but we haven't actually pulled the trigger on it. And I'm just going to pause right here and say that a lot of what I prefer to do behind the veil of an entity. What I mean by that is I may put in place an LLC or a family limited partnership, and I may put the land into that family limited partnership or that LLC, or it could be a corporation. I know a lot of you already have those in place. Excuse me. But the thing is that all that is public information is that you have an LLC, let's just talk about, for instance, an LLC, and that the land is in there. That land, obviously, that transaction is recorded in the Recorder of Deeds office in the county where the land is located. There's obviously an entity out there. But what happens behind the veil of that is not public information. So we may have created that entity, it may still be in mom and dad's name. We may even go ahead and do the transfer and then realize, they passed this and this caused a problem, they made it retroactive, and all of a sudden that paperwork, well, maybe we need to go back and lose that paperwork or refigure that paperwork so that we can, step back and figure out what we need to do. So I do like to do that. I don't, you can do a direct transfer to, deeding land over to the kids or whatever it is that you're going to do, but I do kind of like to do it behind the veil of that entity so that a lot of that is not public information until we report it to the IRS and we know exactly what we've got. The other thing is that, sometimes people come and say, well, maybe I'll just make a $3 million gift. Well, okay, that's very generous of you. I don't want to, I'm not trying to slight that, but the problem is that if we've got a $11.7 million exemption, and one of the proposals is to drop it to $3.5 million, we've got to really get into this area to make it worthwhile. Meaning that you may need to make a $5 million gift because you're going to lose what's above the $3.5 million. But if you're just making a gift up to $3.5 million, well, you're not really doing any good because you just utilize your entire exemption. After they drop it, you're going to have nothing left. So I don't know if that makes sense, but that's something to be thinking about as well. There's lots of considerations in this, and I'm not going to go into the specific details of all the ins and outs because it's complicated. You do need to be talking to a professional who knows what they're doing and thinking about this. But there's ways to build in discounts. So if you've got over the exemption and you need to kind of back that off through the use of entities, you can build in some discounts because you're only getting fractional interest in those. And then the other question is, do you need to does the senior generation need to retain some type of income stream, retain the income or have an income stream which looks more like a sale? And so all of those things need to be factored in as you're kind of thinking about and talking about what you want to do. The other thing I want you to be thinking about is that with the appreciation that's happening right now in land, that's, I think we've kind of got this problem where land's appreciating, the number, the exemptions and are going down, and it just is on kind of a collision course. And so that's the other thing you have to be thinking about is that, well, maybe you don't have a problem right now, but will you in 10 years, will you in 20 years? And I don't know if land will continue to appreciate at the current rate, but with the money that's thrown out the door of the federal government, I think inflation is probably here to stay for a while. So capital gains tax is a little trickier because, if I've got a client, and I do have some clients that are talking about selling a specific piece of real estate, or that was already in the thought process or already in the works. If so, they probably need to get done this year. And that's a little bit worrying even then if they do the retroactivity and it applies backwards, but otherwise I'm almost positive that the capital gains tax rate this year will be less than it is in the future, almost certainly. So I've got a few of those clients that we're talking about, do everything you can to get it taken care of this year so you can pay at this year's rates instead of next year's rates, whatever this might be. I have heard, so a lot of people use 1031 exchanges, which is, I know you all know this, but you basically, if you sell a piece of real estate, you can transfer that money, the proceeds that you get from the sale to another piece of real estate and defer the capital gains. 1031 exchanges are still available. I haven't heard any talk that those are going to go away, so that's still a possibility if that's something that you're interested in. Okay, so I'm going to take questions, but the question mark is both for questions from you and questions as far as what we're going to do. I mean, it's hard right now to be advising people. I mean, I'll just be direct with you because there's so much uncertainty. It's, you know, it's kind of, a lot of what I'm doing is getting prepared, and then we're going to jump once we maybe have some more certainty as far as what's going to happen.